Welcome, everyone. My guest today is Managing Editor James Kleimann to talk about mortgage rates, how the debt ceiling resolution affects the mortgage market, lender M&A activity, and more. First, here's a word from our sponsor. This is Sarah Wheeler, Editor-in-Chief at HW Media, talking with Melinda Wilner, Chief Operating Officer at UWM, about PA+. Melinda, why is it important for brokers to be scaling their business right now?
Yeah, well, one, it's a little bit quieter of a time, so there's more time to invest in making your process the absolute best one that really wows the borrower at the end of the day. But secondly, like we all know, rates are going to come down, and we need to be as efficient as possible to be able to scale for the future when we're all dealing with a whole bunch of refinances. So perfecting the process right now is a great move.
Great points, Melinda. And listeners, you can find out more at uwm.com. James, welcome back to the podcast.
Hey, good to be back, Sarah.
Great to have you back. We have lots of things to talk about. Let's start with mortgage rates.
Yeah, so the Freddie Mac PMMS survey just came out about an hour ago, so it's Thursday, and the rates as of June 1st from the last week came in at 6.79%. It's one of the higher readings we've had over the last couple years, certainly, and it's interesting because the way that these surveys are constructed, they're looking at a week, right? And when we sit here and talk on Thursday, it's a little bit different, right? So when we think about 6.79%, that includes a lot of noise from late last week when rates were well over 7%. And I text with a bunch of LOs across different parts of the country, and they were quoting people in the 7.3, 7.4 range. Their baseline for really well-regarded, people with great credit scores and really strong down payments was 7.1, right? So these are among the highest readings we have had in a very long time. I think November was the last time that we consistently saw rates in the sevens. As we talk right now on Thursday, June 1st, I'm hearing quotes mostly in the mid sixes. And so that's great for mortgage originators. It's great for lenders. It's not as great for the secondary mortgage market because it's that volatility that we talk about, right? I mean, to be able to price an asset that jumps from 7.4 to 6.6 in the course of a couple days creates a lot of pressures, a lot of strains, a lot of challenges for investors and for the commonly the independent mortgage banks that are trying to figure out a capital market strategy. So it's very volatile. I think there are reasons to think that things might stabilize a little bit in the coming weeks. I think we're hearing from a good number of people, the folks on the ground who are saying maybe that was the bottom. Last week's 7 point whatever. And there are a couple reasons
the bottom
for it.
Meaning the top?
The bottom is like, this is the worst. The rates are at their highest level. Activity is going to be at its lowest because, people who are maybe thinking about getting a mortgage, pulling the trigger on locking in a rate, they're not going to do that at 7.1, 7.2, 7.3, 7.4. They're going to wait. People who are putting in offers are going to wait. And so that lack of activity is really, I think that's what they mean when they say this is the bottom, because the rates are so high, right? And now that we're in a little bit more of the 6.5 range, it's not great. Nobody's going to tell you that 6.5 is fantastic, but it's a lot better than 7.5. There are just not many people. If that isn't a factor, if that isn't a challenge for you, you probably don't need a big mortgage. You probably don't have a financing issue that really changes the equation for you, right? So this is why I think people are encouraged that perhaps that was the worst period in this very challenging year and change that we've experienced. And there are a couple reasons. One, debt ceiling deal. It's not fully inked yet, but everyone I've spoken to would be extremely surprised if that wasn't inked. And that's very encouraging. The nightmare scenario would be the debt deal doesn't get done. There's a breakaway group of Republicans, and on the other side, Democrats who won't sign it. They don't have the votes. We default in a week. and rates probably shoot up another couple points, maybe, right? And then, if you don't think people are buying much at 7.2%, imagine at 8 something. So that's a terrible, terrible scenario. And fortunately, it doesn't appear that that's going to occur, although in Washington, anything can happen, right? So I'm going to cross my fingers and hope that that this cake is fully baked. And here are the two bigger factors I think that are worth watching. One, there are strong indications now, notably reporting from the Wall Street Journal, that the Fed is going to pause rate hikes at its upcoming meeting in June, and that's coming up in a couple weeks. And that doesn't mean that we're out of the woods, that the Fed is not going to reconsider if there is very strong economic data that suggests that inflation is maybe way higher than even they had projected it would be at this point. But we've seen that the Fed strategy has been somewhat effective. We're not in the 2% range, right? So that's probably never going to happen in this cycle. But definitely we're seeing in the jobs report that was just released a couple days ago that U.S. employers are gradually dialing back the pace of hiring, and hourly earnings are moderating. And I think that's some solace to the Federal Reserve policymakers who are still trying to get inflation under control. And the government data released on Friday show that payrolls were under 200,000, increased by less than 200,000 in May. And, that's down from the average monthly job growth of, I think it was like 370,000 over the past year. So that's pretty significant. And then earnings only rose 0.3% from the prior month, when they were, I believe they posted the biggest advance in a year. And so these are good signs that the Federal Reserve's policy has worked in at least maybe not fully breaking the labor market, but giving them strong reasons to think that a pullback, when you also consider some of the banking tumult that we've had, is the right measure. And that's very good news for the mortgage market, which, depending on who you talk to, they've already baked in 25 basis point rate. And if it ends up that they didn't have to, and that offers some stability going forward, I think that's a really, really positive sign. And, we're not seeing a big uptick in inventory. Pending contracts still don't look great. We're still way below where we want to be. I think the spring home buying season, now that it is June 1st and Memorial Day is behind us, I think we can all conclude that it didn't really quite reach the level that people had hoped. But again, if we do hit summer period in which we're in the low mid sixes, this could be a pretty active market.
Yeah, all of that is good news. I agree with you that mortgage rates in the mid to low sixes is a stabilizing force, and people, especially after the run up into the sevens, are going to be like, okay, I'm going to pull the trigger. If they're waiting at all, they're like, I better do it now, So I think that has some impact on it. It's unfortunate. Of course, our industry suffers so much when we have those high mortgage rates. I mean, everything just kind of shuts down.
Yeah, absolutely. So I think there's another interesting point we're talking about. We've heard from a lot of loan officers over the last really month or two, with rates being in the mid to high sixes, low sevens. They get what's called shopped around. And I think that's natural. That's normal. Even the CFPB has put it out there that people should be shopping for lower rates, and it could save you a couple $100 a month. And when affordability is already at its worst point in, I don't even know how long, many years. If you can save a couple $100 a month, you should, right? That's not good news for loan officers. The only thing worse for a loan officer than being shopped around is not being shopped at all. And right. So we're now, we're probably just getting out of the area in which a lot of those leads end up being a battle, right? So when people are in the 2s and the 3s and the 4s, you go with a mortgage broker, you go with an LO at a retail shop, and you probably stick with them, and they probably have a pull-through rate That is, I don't know, in the 80s, 90s, whatever, when rates are in the high sixes, low sevens, and you're quoting somebody $3,800 a month in a mortgage payment, people are going to say, you know what? I'm going to see if I can do better. I'm going to see if I can get it to 3,300 or whatever. And so a lot of LOs have lost loans as a result of being shopped around. And maybe that means their competitor was willing to lower their comp, or maybe they had different products that they could offer that you couldn't, or just that their operations get into a pricing war. And you're going to see less of that in the low sixes, mid sixes. So that is one additional benefit for the practitioners, the LOs who are, nobody has a very full pipeline right now. And so that will help. And when you're losing one or two loans a month and you're only doing three, that's tough. That's really tough.
That is really tough. Another part of the debt ceiling deal that affects mortgage, which Flavia wrote about, one of our reporters, was the fact that student loan debt payments will resume under this debt ceiling. So, I don't know how much that affects, but what did she find in that story?
I don't think that there is going to be a big impact on this. You see this thread, this commentary a lot from the folks who think that there's a housing bubble and everything is going to burst, and this is just one more pressure. It's often the same folks that think that there's this huge market of Airbnbs that are going to blow up, and no one's going to be able to recover from a recession. That means Americans won't travel or whatever. I don't think it's true. One reason is because even though payments have been on pause, the underwriting requires that LOs and lenders factor that in to the DTI. And so on paper, those payments have already been written into the loan. Does that mean that people who maybe lost a job, or maybe there was another negative economic factor that would be paired with them not having, say, an extra $300 or $500 available to put into their mortgage, could that be a factor? Yeah, I think so. I think there are always going to be people, especially those who bought in 2022 when rates were high, relatively high. There was a survey that came out by Clever Real Estate the other day that found something like 2/3 of borrowers surveyed who bought in the last 2 years have experienced some trouble coming up with their mortgage payments. If you are someone who has student loan debt, you weren't paying it during this period, and you also didn't set it aside, and maybe there's another issue that comes up related beyond just inflation. I could see there being some people who are affected by it. The hope would be underwriting is better. It's just so much better than it was pre-great financial crisis. And I would like to think that most of those loans will be okay. And look, that's terrible for the people who might be facing a challenging situation. But if it does lead to more inventory, that from a macroeconomic perspective wouldn't be the worst thing. If you have people who are already over levered and now they just can't afford that $500 payment that they had, built into this underwriting, it just means somebody else will take it, right?
Yeah, I mean, that's the thing. There's not going to be a bunch of foreclosures based on student loans, because like if you're getting into trouble, if you're getting late, you can sell your house. I mean, obviously, like you said, that's sad for that person, but it's not like they're going to, go into foreclosure and it's going to be 5 years. It's going to be a vacant, boarded up house. It's just nothing
Right.
like,
That's not
the
going to happen.
last time. This time they're going to sell their house, probably still have some money to spare on that. So, definitely not a huge hit to the mortgage market, I don't think.
Or more likely, we have so many new loss mitigation tools available, and one would expect them to pursue an option like that before declaring, some sort of, oh God, I can't pay this, I'm just going to sell the house. There's also, I believe the Supreme Court is going to be reviewing, ruling on the Biden administration's case to forgive between $10,000 and $20,000 in student debt. If that does come to pass, then certainly there are people who would benefit tremendously from having, up to $20,000 wiped out. I just don't think that there's going to be a huge cross section of people who have student loans who are already near the limit of what they can pay and haven't been paying, setting that money aside or using it toward, the mortgage payments and don't have the equity, right? We also have to think about the equity position. So this would, in a lot of cases, only affect people who pretty recently bought the home and don't have a lot of other options. And I think there are very few homeowners who check all those boxes.
I know one of the points that Logan often makes, Logan Motoshami, our lead analyst, is that the people who would benefit from the $10,000, if you have $10,000 and below in debt, and that is the majority of people, I think it's like 70% of student loan debt. And many times those are people who weren't able to finish college, so they're not getting the benefit of a better job. And oftentimes those are not people who have secured a mortgage. So
yeah, that's a good
it'll
point.
be interesting to see, but I think from all perspectives, there's not a student loan debt crash coming, and I think it'll probably be a small blip for the mortgage market.
Yeah, and unfortunately, though, there still hasn't been a proper policy reckoning with student loans. I don't have any student loans. I managed to pay them. My wife still has some, and we're in our late 30s, and we're, I think, very fortunate. I know people who are making good, not great money, living in high cost of living areas that have $600, $700 a month payments or more, and they're going to be going on and on and on. And there are a lot of, there are a lot of arguments for and against forgiving the debt, but there doesn't seem to be much effort to really rein in the costs that have contributed to this issue in the first place. And it's a significant contributing factor in why millennials are not able, despite the numbers, right? There are so many of us, and they're still not able to get a house. They don't have the equity, and then they have these high payments that are fixed. And the job market, although I think it's still a pretty good job market, actually, is just it doesn't lead to them being as competitive as they could be.
So the Supreme Court has decided to hear that this session, right? So in between
Yes.
here and October, or is it starting in October? I should know this. First Monday in October. Anyway, interesting. So you talk to a lot of loan officers, and I try to talk to people as much as I can at conferences. You and I were just recently at the MBA secondary event, which obviously didn't have maybe a lot of loan officers. But as you're talking to them, how are they feeling about this? What are they, in general, how are they getting through this market?
Yeah, we're seeing a lot of high performers, those top LOs who are on the Scotsman Guide lists and National Mortgage News and all that, and they're still very much in demand, and that's because they have, generally speaking, really strong structures that are set up, and in most cases they have been through a couple cycles. These are by and large not 28-year-olds who got into it in 2018, 2019 and are thriving right now. There are some that they exist, but it's some minority, absolutely. And so those top performing LOs very much in demand. We're still seeing signing bonuses thrown at them. Those can be what they call golden handcuffs sometimes, and they do prevent some loan officers from moving to different companies, and often we see things like, and this is big in real estate, people always say, oh, well, the reason I moved, it wasn't money. It was a culture fit. I'm sure that happens on occasion. 90 something percent of the time, that's absolute nonsense. They move for the money. In other cases, they'll move because they get better support or they get more marketing strength, or maybe they get an opportunity to build a team in a different way. There are a lot of different compensation models out there also that allow some people to pay by lead type, or to get paid rather by lead type, and so it's pretty interesting. We definitely see companies like Cross Country, Revolution, UMortgage, several others that are definitely in growth mode, and using this opportunity when it's a not a dead market, but a barely breathing market, to make moves. And you know they're all a little bit different, but at the end of the day, they all do the same thing, right? They're trying to sell a mortgage to a customer, and so much of it comes down to getting the lead and working the phones and going to the t-ball games and going to the Rotary Club and networking with real estate agents. If you were a mortgage loan officer and all you did was refis in 2020 and 2021, what good are you to a real estate agent in 2022, 2023? Your skill set doesn't match what they need. And so the best loan officers are still looking at pipelines that are, generally speaking, down about 50%, even the best ones. And the worst ones, not worst, I don't want to frame it in such a negative light, but those who are not as productive are just out of the game. They haven't originated a loan in 4 or 5 months. You're working at the mall now. You're working, selling Verizon phones or whatever. You're doing something else. Maybe you're in a different sales position. That doesn't mean you can't sell. But you need a network. You need to be able to capitalize on the few opportunities that are going to come your way. Because as we said earlier, there just aren't a lot of people who are in the market right now for a mortgage in the mid sixes and the high sixes and the sevens, right? So if you can't be strategic, if you mistime the market, in some markets, real estate is always about local markets, right? So when we talk about the market, what's happening in San Francisco is wildly different to what's happening in Lexington, Kentucky, and down in Palm Beach, Florida, or in the New York suburbs where I am. And you need a different strategy. So one of the frustrating things that I often hear from LOs is a lot of these big national lenders have these not one size fits all strategies, but they'll talk about, certain, marketing promotions, or certain, here's how to get first time home buyers who are looking for an FHA loan in, getting them into a house. And if you're an LO outside of Boston where entry level is in the sevens, that doesn't help you. What does that do for you? And the company is spending all this marketing money. Now you no longer have a loan officer assistant. You don't have as many underwriters. You don't have all of the people who make this process happen. You have less support staff, and that's the nature of the game, right? There are only so many mouths that can be fed by a certain amount of business. And so they're not salty about that necessarily. But then when they see a company that seemingly doesn't know what they actually need, prioritizing products and services, and, telling them to make TikToks about, how to help with certain borrowers that are never going to be in their target market. It's kind of like, why are you spending money on this? Why aren't you listening to me? I need something else. And they grow frustrated. And, the tools for an LO in a competitive market out in Boston are going to be so different than the tools an LO in the suburban Detroit market need, right? Because there you need to figure out how to work with definitely more first-time home buyers who are going to be of lower or moderate income, who might need help with down payment assistance, or might need to know the ins and outs of why an FHA loan maybe works better than a conventional mortgage for their situation, or it doesn't, right? And so it really is a game in which you have to know your borrower's financial situation really well. You can't have a DTI surprise at the last minute, right? You need to know what their strategy is, what their plan is. An LO that I talked to in Boston, real experience, she's got 30 something years in the game. She's been through every cycle. She knows her stuff. She's a high performer. And what she needs is so different than what an LO in Florida who's working with condo buyers needs, and I think in a lot of cases, the lenders haven't quite caught up to the nuances of figuring out how to work in a tough environment. Everybody feels good when rates are in the threes and you're making money. But it's it's a totally different game now.
It really is. And just like we're seeing, you're talking about, the really high performing LOs are still going to be fine. And then you have a lot of people shaking out. We've seen a lot of M&A this season, over the last few months. And we just had one that we reported today about Planet acquiring Platinum Home Mortgage Corporation, right? So, Platinum, not a huge name, but had like 70 offices, something like that, right? They had, 22 branches and 79 active loan officers. So not huge. But it just shows you, we think that M&A is going to continue to heat up.
Yeah. And it's going to be those types like Platinum. It's, if you're under $1 billion in origination volume per year over the last 12 months or whatever, you don't have the scale. You don't have the ability to withstand some of the challenges that a bigger player is able to work on. You don't have the MSRs that you can sell. You probably have to deal with, just a lot of different factors that a Rocket, a UWM, even a Planet, doesn't have to deal with. Planet's been pretty acquisitive. They've been pretty aggressive, and they've been moving up the rankings as well. They bought Home Point's correspondent business about a year and a half ago or whatever. And again, they're one of those companies like Guilds, like UWM, like Rocket, that are thinking strategically and making a lot of plans for the future. They're thinking about a cycle that's a little bit better than this. And, everybody has to insulate themselves. Nobody can be just arrogantly throwing money away and making decisions that are going to come bite you, tomorrow, not even next week or, months from now, years from now. But if you can't plan out more than a couple months from today, it's really telling. And if you are struggling with your cash position, as almost every independent mortgage bank in America is, at some point the cash runs out. You're also not in as good a position when the market turns to work with the borrowers, to work with the real estate agents. So what we've seen over the last couple of years has been that sort of consolidation, that the bigger players are getting bigger and the smaller players are having to partner with others, whether it's through a JV or another acquisition type, or they just go out of business. And I was at the secondary conference with you in New York last week, and we heard from a couple panelists. We're talking about efficiencies in mortgage, both the primary and the secondary mortgage markets. And I can't remember the panelist, but he said, it's not like you just shut down a mortgage company either. You don't just say, okay, I guess we're done. You still have a lot of work to do at the end of it. And so for many of the folks in this position, the under 1 billion in volume especially, they have to find a dance partner because the money is going to be gone in a couple months or less. We see originators that I think of as pretty decently sized, more in the 1 to 4 billion range. And there are lawsuits that say they're not paying their rent, that they're not paying their vendors. And this is going to continue. The first quarter was not as rough as the fourth quarter of 2022, but it wasn't good. The average IMB lost $2,000 or so almost per loan. I don't think the second quarter is going to be, hey, they made, $1,200 per loan. It's still going to be a loss in the second quarter. How many companies in America, period, forget mortgage companies, can sustain 3 to 4 quarters of losses on every product they make?
It is so rough. Well, James, thanks for being on today and bringing us up to speed. Your newsroom's doing a great job. We hear rumors of M&A constantly, and I really appreciate the fact that the reporters and editors at HousingWire, under your direction, do a great job and make sure that, because there's all sorts of things flying around that are not true, and that they get to the bottom of it and give us great reporting on these things that do happen.
Thanks, Sarah. Good to be with you.